Hey everybody, it's Pete. Welcome. Today is Friday, May 1st, 2020. We're actually done with April already. The pandemic is still going on. What was supposed to be the worst or the worst of it during April has come and gone. Let's hope we can start getting back to a normal life. You're going to start seeing me wear a hat a little bit more often because I need a haircut desperately. It's it's starting to get out of control, and my Italian hair is pretty thick, so it starts to get up there. We want to today start going into the new month with some goals, some concrete goals. But one of the first ones I want to talk about is whether or not you should set a daily goal. We're also going to talk about what type of securities you could trade that match your specific personality and your experience level and your bankroll. Two very important things. I'm going to tell you what I believe is by far the easiest way to put yourself in position to make money on a regular basis, provided you actually have a strategy. Obviously, mine is the order flow method. So we're going to dive into all of that. If you find these videos helpful, please do me a favor, click down and subscribe. But here's what I want to talk about first. I'm going to ask you for your feedback. I'd like to know, and if you could please leave a comment on this, we'll have sort of an exchange back and forth and follow up with another video. What do you believe is your strongest challenge right now to being the type of trader and making the money that you believe you can possibly make as a trader? What do you believe is stopping you from achieving your trading goals? What do you believe you're missing? What do you believe right now is the reason you are not making what you believe you should? Why do you believe it's frustrating if you're frustrated? And probably the most frustrated person ever is somebody who is trading and studying trading for a long time. They've stopped losing money, but they haven't been able to get profitable. If that meets you, what do you believe is stopping you from taking that next step and taking off where every single month, month after month after month, your account equity just keeps growing? What do you believe is the reason for that? So there's two separate types of traders that we're specifically speaking to right now. Somebody who's brand new, excuse me, somebody who's brand new and everything is overwhelming. What part of that market is overwhelming? What do you believe is confusing you? Put those posts in the comment. And if you're on the other side of that, where you've stopped losing money, it's not as confusing, but you can't get paid. What challenges do you believe that you have? I want to talk briefly about the different types of securities. So for example, excuse me, options, trading ETFs, such as the SPY or the QQQ, those kind of things, trading index futures, and then obviously trading stocks. They all have their role. I think that's really one of the most important things that I want to point out here today. Some traders exclusively trade E-mini S&Ps, and now they've actually come out with E-mini micros. And I think that they've done that to allow more retail traders to get involved in the market with lower margin levels, and you could manage your risk a little bit. I don't know why I have a sore throat today. So anyway, I want to walk through the progression of each one. I don't want to put a rating system on each one of them. Obviously, I'm stock trading pro, so I'm a little bit more. My career has been as an equity trader, and I've been teaching equity trading for a while now. But there's a reason for that. If you know anything, or if you've gone through the coaching program, or if you've watched the videos, everything that I do is based on having an edge and making 10 perfect trades. And the reason it's for 10 perfect trades is we want micro batches of samples of, if you make 10 trades in a row, you should make money provided that you have a strategy. And if you don't, it's easy to go into those 10 trades and say, okay, why didn't I make money? Was it because I poorly managed the trades? Was it because I didn't pick the right trades? Those kind of things. And then you fix that, and you immediately after 10 trades start to get closer and closer. If you're not familiar with my concept of 10 perfect trades, it essentially means that if you do everything right within 10 trades, you should make money, provided you have an edge and you let here's the key, you let your edge do the work. You don't get all stressed out about everything. You put a trade on, put a trade on, put a trade on, providing it's the right trade. And I'm kind of tipping my hand here on why I like stock trading, and I'll get to that in a second. If you don't put on perfect trades, if you take trades because you're bored, if you take trades because Jim Cramer said something, if you take trades because somebody in a chat room called out a stock that you've never seen before, those are not perfect trades because they don't match your perfect scenario. Maybe the scenario does, but it's not your work. Excuse me. It needs to be your work because you need to have conviction behind the ideas. If you're waiting for somebody else to give you ideas that for a strategy that doesn't match you, you have no idea if the guy down the block or on what chat room that you just logged into or some forum or a Facebook group, if that strategy has anything to do with how you trade, your risk, your experience, all of those kind of things. So if you make a trade that's not a perfect trade, you start to push out how many trades it will take you to get profitable. And this is kind of getting back to where I was talking about somebody who's experienced but can't make money. They're still making those trades. So maybe 7 out of 10 trades are perfect and those 3 are garbage. Now at a minimum, it's going to take them 13 trades to get profitable. And then it takes 16 trades and because they don't even realize they're doing it. It's a vicious cycle of making 3 good trades, 2 bad trades, 3 good trades, 2 bad trades. And now I'm not talking about trades based on whether or not you made money. So let's be very clear on that, because there's plenty of trades I make that are great trades that don't make money. The fact that it doesn't make money is not making it a bad trade. If I follow my rules, if I trade it flawlessly, that's still a good trade. That's a part of the probability. That's a part of the 10 where we should make money. So that's why good traders, or I should say smart traders, I can't say good traders, you're a good trader if you're making money. That's why smart traders have a trouble getting paid. It's also why new traders feel overwhelmed because they feel like they need to watch everything, which is the biggest mistake you should make. When I first started trading, we were only allowed to watch one stock and trade one strategy. And back then, what was known as scalping teenies. We were just trading level 2 back and forth and getting in at $50 and getting out at 50 and 1/16, buying it at 50 and 1/16, selling it, at 50 and 3/8, like right above where we were. So that's stock trading. Stock trading has many different applications. Stock trading, whether it's scalping, like I just explained to you, it's easier. And here's really the point that I want to make, and then I'll get into the other securities in a second. And I'm trying to help you really think through how much money do I have? What is my experience? What are my goals? Those kind of things. And what's realistic for me to make money? And the story that I use all the time is, if you have enough money to open a hot dog stand, you shouldn't be trying to open a Walmart. What I mean by that is, should you be trading $300, $400, $500 stocks that have massively wide swings without the experience to run a business like that? You have to pick the right fights that match what you can do now. Don't pick fights where you're going to be right on the trade, but you're going to get whipped out. You're going to get whipped out. You're going to get whipped out. And all of a sudden, things are all over the place. And 3 hours later, or 3 days later, or 3 weeks later, the stock did exactly what you thought it was going to, but you couldn't stay in the trade because you didn't have the experience to manage that kind of volatility, or you didn't have the capital to sit through those kind of swings. Could you do that with options? Maybe. We're going to talk about that in a second. Here's the point that I want to make, and this is very specific towards trading stocks versus futures. I want to start out talking about that first. If my entire concept, which is now proven over time, if my entire concept is 10 perfect trades, I will flat out tell you, I don't know you, never met you before, maybe I have, I don't know. It is infinitely easier to have 10 positions of 100 shares than it is to have one position of 1,000 shares and get profitable. Because if you have an edge and you take 100, 100, 100, 100, and you have 10 positions of 100 shares, within those 10 trades, the probability should work themselves out. If you have an edge, and again, mine is order flow. If you have an edge, the edge does the hard work. And now you're letting it play out over time, over 10 samples, over another 10 samples. So that by the time April just finished, you have all of these 10 perfect trades, and maybe you put on, and I'm just throwing a number out there. Maybe you did 10 perfect trades per week. So you had 40 samples, or maybe you did 10 perfect trades per day, which is easy to do, by the way, trading stocks. Letting those probabilities play themselves out is an easier way, and here's the thing, a less stressful way to make trading profits. If you are trading with leverage, which is obviously what S&P futures are for, right? You could trade with leverage, put a much smaller margin amount, right? You are exposing yourself on one trade to bigger upside and downside. And I'm going to get comments about, oh, but the upside's so much bigger. Yeah, watch the downside first. The downside is managing the downside is what keeps you in the business. Learning how to make money is where business growth comes from. So you first have to learn how to stay in the business first. Here's when you would use E-minis, which is exactly what I do every day. When I have good stocks in my game plan, I allocate money and buying power to all of those stocks. I don't pick and choose which ones I think are going to work out. I never pick and choose. I'm like, there's the signal, put it on. There's the signal, put it on. There's the signal, put it on. But when the market lines up, where the market internals are doing exactly what I need to see, when all three indices are doing what I need to see, when multiple time frame analysis is lined up and doing what I need to see, that's when you use more leverage. That's when you go in and say, you know what? Maybe I want a bunch of futures contracts right now because I'm seeing the perfect storm of my strategy unfolding right now. That's when you use leverage. If you are trying to use leverage in an E-mini contract, when the market's choppy and going sideways, and I'm kind of bringing this up because we've had a lot of that over the last 3 weeks, specifically as a day trader. If you're trying to use leverage in a choppy market, you are going to get chewed to pieces. You are going to get stopped out, stopped out, stopped out, stopped out, stopped out, stopped out. It's finally going to pick a direction. Your account's going to be wiped out or significantly drawn down, and then you're going to see it go in that direction that you thought it was going in the first place. So think about the difference between those two. On a day in and day out basis, it's not hard at all to find stocks that match the perfect trade criteria, provided you have the criteria in the first place. That's easier to make money in the long run because, again, 100 share trades, you don't have to size up. As a matter of fact, I don't recommend you size up until you prove you can make money. And not to me, to yourself, to your account. Easier on a day in and day out basis to have 2 positions, 3 positions, 4 positions of 100 shares at the same time. And then when the market lines up, which let's face it, how often does that happen during the week? 3 times, maybe? So 3 times during the week, 3 trades during the week. Maybe you get a killer scenario where, oh my gosh, everything, I got to hold this thing. That's when you size up and you use leverage. So when do you use options? Options probably, for me personally, definitely, are for either getting involved where you don't want to use necessarily a stop loss on your trade. And I'm talking about maybe a little bit more swing trading than day trading, where let's say you believe the S&P is going up or down over the next 5 days. Maybe you buy S&P futures or you buy the SPY ETF and you have a certain amount of shares in whatever direction you believe. And at the same time, you buy puts to protect your downside to allow that to fluctuate. So in your mind, the puts will be the protection that you need as a stop loss, as opposed to if it goes down and you get taken out over a multi-day period, which you see quite a bit, where you could be right on the direction but not make money. Using options, provided you understand, I'm going to put a caveat out there, provided you understand how to recognize the premium that makes the most sense to use as an option trade. So all you options traders, don't email me with Greek figures and stuff. That's not the point. This is a general thought process to help everybody think through how they trade. And using a stop loss, a synthetic stop loss, I guess is what I would call it, by buying a put to manage the downside. I do have some people in the chat room right now that are day trading options in the, instead of trading a $300 SPY, which actually it's $295 in that area, they're using the leverage of options to day trade them, getting a bunch of contracts for that very short period of time. Is whether that's awesome or not, that's completely up to you. I'm sure I'm going to get options traders telling me why it's not. I will tell you this. Some of the best options traders that I've worked with and traded with, they say buying options just because they're cheap and you can have leverage and because you know your downside, those are the 3 worst reasons to use it, but that seems to be why most people do use them. again, this isn't going to be an options. This is more about different scenarios you would use different securities. Personally, myself, I find it easier to swing trade options, to build positions over time, just from a buying power perspective. And let's face it, if you've gone through the program and you understand the tape reading principles that I walk through, quite frankly, it's not that hard to determine where something's going over the next 3 to 10 days. And that's really where you can take advantage of those swings. So on an intraday basis, the 10 perfect trades with multiple positions at the same time of 100 shares to get to 1,000 shares versus one position of 1,000 shares versus always trading futures. In my opinion, in my experience, it's a lot easier to have multiple positions spread out as long as those positions match your edge. Don't just put on 10 trades and it has to match your edge. When the market lines up in a powerful way for a day trader, that's when you want to size up on your leverage with futures contracts. And then swing trading over a little bit longer period of time, depending on your buying power. If you have sufficient buying power, you can do the same thing with your swing trades. If you don't have additional buying power, but you feel like you're getting good at reading the tape and you're like, wow, this is happening, that's happening, this is happening. I think the stock is going up for 5 days. That's when you can take advantage of options if you don't have sufficient buying power. So I guess what I'm trying to do here in this video, in this episode of Stocks for Breakfast, is make you think through what kind of trading business makes the most sense for what you're bringing to the market, and then which securities are the right ones for you to use to accomplish your goals, which that's kind of where I want to end up on the last one, is it's very, very difficult because of market conditions to set daily goals as a day trader. I just want to touch on that just for a second. Day trading and setting daily goals is very challenging. Let's just say, for argument's sake, you say, I want to make $500 per day. Okay, that's great. So what if today the market's really tough and you made 250? So does that mean your goal for tomorrow is 750? What if the market's tough again tomorrow? We had almost 2 weeks of the market kind of going sideways. Yes, there was individual stocks out there that you could take advantage of, but what if that happens? Here's the simplest way to break down your goals. If you're a day trader, and especially a full-time day trader, trade for the week and trade for the month. Measure the week based on whether or not you made perfect trades, and measure the month based on what your monthly goal is. All businesses, it doesn't matter if it's a trading business, all businesses measure what they did monthly. You say, okay, April just ended. How did we do last month? Now, the weekly goals tell you, do you need to make adjustments during the month? Is the market tough, or am I missing something, or am I not following my plan? It's infinitely easier to end the week, like today's Friday, tomorrow I'll go through everything I did during the week and monitor all of my trades. How did I do? Did I do it flawlessly? So I go into my during the market, after market, and pre-market trading journal, which I do keep. You should be doing the same thing as well. What do I expect to happen during the day? What was I thinking during the day while I was executing my trades? And what did I think of the market? Because I might be reading it and saying, wow, this is a really tough market, but still trade anyway like a dum-dum. And then after hours, what was my recap of how the market unfolded and how I followed my plan? And then Saturday, I review all of that. You need to do that, because if you just keep going day after day after day, week after week, and month after month, and you aren't in this feedback loop where you're trying to make adjustments to get better, you're just going to stay there. You're going to stay there in that loop, and it's going to be 4 years later, and you're like, I have every trading book on the planet. I don't understand why I can't get profit. Because you're looking in the books to make your money as opposed to looking to your results to make you money. Now, you absolutely should be buying books. You absolutely should be trying to improve yourself to get ideas. Obviously, I'm a book maniac. But the books are a foundation. Your real trading, being out in the real world and actually getting your real results, that's where you iterate and you get feedback. Place a trade, get feedback. Place a trade, get feedback. And that's where your account starts to go like this, because you're actually paying attention to the results. So Stocks for Breakfast today was a little bit different. I wanted to head into the weekend and give you some things to give you some things to think about in your own personal trading, because if you don't think these things through, you're never going to improve. So you should be a learning machine from your own results, and then ask questions. That's the whole point of these videos, is to get in there and ask questions. So I'll go back to what I started out today. Definitely post in the video, what is your biggest challenge right now? Maybe even put in what your experience level is and then we'll do follow-up. Maybe we'll even do a live video where we can go back and forth, which I think would kind of be fun. So that's Stocks for Breakfast, May 1st, 2020. Have an awesome day. Please subscribe and absolutely leave your comments. Take care, everybody. Be safe.